Do you feel like you're paying too much in taxes every year, or have a relationship with your current CPA where you only meet them once or just before tax time? Look, I want you to know that there is another solution to paying less in taxes and keeping more of your money. Valentino Advisors is a leading fractional CFO and CPA firm that specializes in advanced tax strategies for founders, athletes, and entrepreneurs. Valentino Advisors can help you navigate the complexity of business taxes and ensure that you're paying the least amount in tax possible. But this is far more than tax preparation. This is strategy. This is really getting into the data-driven decisions that your business needs to make in order to develop a long-term strategy that aligns for your business and personal goals. Whether you're looking to minimize tax liability, maximize your deductions, or plan for your financial future, Valentino Advisors has the expertise and experience to help you get there. Do not wait until tax season. Work with professionals today. Contact Valentino Advisors to schedule a consultation. And for the listeners of Generation Wealth, go to www.valentinoadvisors.com and join my business partner, Kelly Ward, and I at a live workshop where we talk about how to make tax-free money legally. Again, that's www.valentinoadvisors.com. Oh, guys, I cannot wait until you listen to this interview with Marco Santarelli. He is a two-time Inc. 1000 entrepreneur. He's been investing in passive real estate for decades. He's an author. He's a Broadway show producer. He's invested in so many other businesses. It's really incredible to talk to someone that has the depth of experience like he does and is also able to break down the data and what's going on in the market now in 2023. He's the founder of Narada Capital Management and Narada Real Estate Investments. And I love his strategy of how he's helping investors. We even go into the interview and disagree on one thing. I mean, not totally disagree, but we are coming at it from two different perspectives. So I always love those types of conversations as well. Let's dive in. Welcome to Generation Wealth. I'm Candy Valentino, and I've been building businesses and generating wealth before I could legally order a drink. For more than 2 decades, I've built, scaled, acquired, and exited businesses, all while investing in real estate and building financial freedom. Now I want to help you expand your wealth and give you the proven roadmap to implement today. It doesn't matter if you're a part of Generation X, Generation Y, or Gen Z. It is time to join Generation Wealth. Now let's get started. Guys, I am so excited for you to listen in to this interview, and I am super pumped to have you on the show. So thanks so much, Marco, for joining us.
Candy, it's my pleasure to be on. I'm really looking forward to this.
Yeah, we connected on your podcast, which you have a great podcast you've been doing for a long time, when I was promoting my book, and I loved our conversation. So I wanted to be able to bring you on because you're already doing stuff and you've been doing it for a long time. There's so many people in the real estate space that are just now talking about it, and maybe they have their first deal or their second deal. But you've been doing this a really long time and teaching it. So can you share a little bit with the audience just about what it is you do? You're passive, obviously focused on real estate, and a little bit about your background.
Sure. Yeah, no, I appreciate you asking. So real brief, I've always been an entrepreneur since I was a mid-teen. So I'm a serial entrepreneur. I'm an investor, love real estate. I got started when I was 18 years old, bought my first rental property, renovated it, managed it, did the whole thing myself. So the writing was on the wall pretty early on. But I've always invested in real estate, and then I branched out into investing in other businesses and everything from crypto to cannabis. But I have a deep love and passion for real estate. I teach how to invest in real estate and all kinds of strategies, mostly on the passive investment side, not the active side, but I've done all of that. I've probably fixed and flipped 300 houses. And then that kind of branched out to be a little more eclectic, if you will. I mentioned I've been investing in cannabis and crypto, but I'm even investing in nonprofits as well as Broadway. I have 7 Broadway musical productions that are either in works or they have been released and are running right now. So
that's a new one I've never heard of on the show. A Broadway show. That's really cool. Yeah, that's interesting. Are they highly profitable?
Well, it's interesting that you asked that question. So it is a very high risk industry. Out of 10 Broadway musicals, 7 will not recoup your original investment.
Wow.
Two of them you will recoup, maybe make some money, and then 1 out of 10 you'll actually make some money. And sometimes it's really good money, like production, like Hamilton will knock it out of the park.
Hmm.
So you write a check when you invest on Broadway in a production as if you'll never see that check again. But when you do make money, it can be fairly lucrative. Interestingly enough, you know that saying where you should invest in the jockey, not the horse.
Hmm. Yeah.
There's a lot of truth in that with Broadway. Now, it's still a high risk, and investment, and there's an element of gambling in there. But if you have the right story, the right team, the right writers, and the right lead producers, you increase your odds of recouping and making a profit significantly. Fortunately, one of our productions that's live right now, which is with Neil Diamond, it's called The Beautiful Noise, is doing extremely well. We're doing about 1.1 million a month in ticket receipts.
Oh,
Um,
wonderful.
yeah, and then another production that's running right now for 10 weeks literally just got nominated for a Tony Award a couple of weeks ago. So I'll be at the Tonys in 3 weeks from now with my little tux and bow tie on.
Awesome. I love it. And then
Fingers
the other
crossed.
ones that don't make any money, right? They're just offsetting your gains in real estate. So, right, you can just take those as a loss.
Yeah,
So
right.
that's so cool. And that's what's so great is you obviously have the passive income. So
Yeah.
when you have the passive income set, it gives you the ability to do so many things and so many different businesses and verticals that it's not like you're, betting everything on the farm and if it doesn't work because you've already got this other stuff established. Now, I like what you said. You don't do active, you're not doing flips and you're not doing wholesaling, I would assume that you're doing just all passive. Do you do multifamily, commercial? What's your fave?
Well, that's a good question. A lot of people, you're asking a great question, I think, for your audience, because a lot of people think that they should start with simple investments like single family homes and then work their way up to, let's say, duplexes, fourplexes, and ultimately work up into what people refer to as, big real estate or apartment buildings.
Mm-hmm.
And some people do that, and that's what they want to do, and it's great for them. But it's a slightly different animal. But there are a lot of people who are very successful just building a large portfolio of single family homes and as well as duplexes, triplexes, and fourplexes. That category, those four, are what we call residential real estate.
Mm-hmm.
Even though apartments is residential, but it falls in the commercial side of things. So the financing options available to you as an investor in apartment buildings is not as lucrative or attractive as residential real estate financing. So it's your choice. There's no right or wrong answer. If you want to go the apartment route, do it. There's nuances to it. You're dealing with big real estate and major mechanicals, and it's a little bit more expensive, but there are a lot of successful real estate investors that make a lot of passive income and create a lot of wealth just investing in basic single family homes and duplexes. It's been going on for decades and decades and decades.
Mm-hmm.
And that's really who we've been catering to. And people will build, some of our clients have 40, 50 homes. They built it over a period of, X number of years, and they're doing extremely well. They have no interest in going to apartments.
Yeah,
So,
I always say that you can make money in any vertical in real estate. Just decide how you want it to fit into your life. If you have one apartment building, even if it's a 30-plex or 40-plex, and you have a business or another job, who's going to manage that property? And making sure that it's really tough when you're starting something to go big. Like I always say too, it's easier to step into something. It's a little easier to understand. You have more flexibility. Start with
mhm.
single family if you can, and then if for some reason it doesn't work out, you could live in the property. Maybe you could short-term rent the property. Right? There's a bunch of different flexibility in that market in order to do that. If you buy it wrong or you find the wrong property and you overpay and now you don't have the rents, that's a much bigger risk than just one single family home that you could probably put back on the market. So if someone's listening now, I have like so many questions I have, but I'm trying to like take them back. If someone's listening now and they're just maybe their first two homes, right? Their first few, what would you say is the best thing in this market, 2023, that you would recommend to someone to start looking at for investments?
I'm a big fan of single family homes, and here's why. One, about 70% of the housing stock in the US is made up of single family homes, which means it's not only the most abundant form of real estate that you can find out there, but it's the simplest, it's the easiest to understand. There's the least amount of competition for it, and there's the most amount of inventory for it. So it's easy to find, relatively speaking. It's easy to get into it. It's easy to sell it. In other words, liquidate it if and when you need to. And typically, you'll never sell real estate for the sake of selling real estate. You'll only do a 1031 tax deferred exchange into other real estate or more real estate. But because it's so abundant, it's relatively easy to get out of it, not just into it. So the abundance is a factor. The fact that people love single family homes as a tenant, because it's your own private yard. You have your own four walls. You're not sharing with other people. You have a yard. There's that feeling of home ownership, even though it may not be your home. So there's a lot of benefits to single family homes, both as a landlord and as a tenant. That's why I love single family homes. The next best, in my opinion, is the duplex because it still offers a lot of that privacy, even though it's not completely private. And the financing for residential, as we talked about before, for the 1-to-4 unit, you can lock in on a 30-year fixed rate mortgage, which is not doable in the commercial space. The maximum term or loan is 25 years, and you have to renew it, every 3 to 5 years. So you're essentially recasting that interest rate and it might go up. So it might become unaffordable, which is a concern in the commercial space today because the commercial sector in our economy is not doing so well. And banks are already gearing up right now for what might be a small tsunami of foreclosures in the commercial space. Mm-hmm. Yet on the residential side, I might be going off on a tangent here, Candy, but on the residential side, because there's so much demand for residential housing in general, and there's a lack of supply, and this has been true for a long, long, long time, the cards are stacked in your favor as a real estate investor and a landlord. So this is why I love residential real estate. So that's where I would start if I was a newbie, a brand new real estate investor, or if I was a seasoned real estate investor, but I wanted to continue building my portfolio. I'm more likely to find single family homes or duplexes to build my portfolio than looking for apartment buildings where it's more competitive. A lot of people are chasing that inventory type. And for the most part, the cap rates are lower, which means that your ultimate cash on cash return will be lower on the commercial side.
I love that. And oh my gosh, I have so many different areas we could go in. I want to just touch back about commercial for a minute, because you're one of the very few people that I think maybe follows this and nerds out on the data as much as I do, because no one else has brought this up about all of the debt that's coming due. And we're talking into the trillions on the commercial space, and how a lot of those, there's going to be a lot of opportunity for that type of investor, of course, to pick up some of that potentially if that's the way they want to go. Can you maybe share, just for people that, because I don't think we've talked about this yet, just share a little bit about what's going on in the commercial space, and if you would necessarily start to try to pick those properties up once they come due, because I think they're really going to be underwater, or would you stick with the strategy that you've always used?
Well, first of all, I would stick with the strategy that I have known for my whole life, that I'm comfortable with, that I know is tried and true for me and for thousands of our clients that have built their wealth and their passive income over the years with nothing but residential real estate. Again, 1-to-4 unit properties. Mm-hmm. So I have no intention of changing, even though I will say that in time, there will be some probably great opportunities in the commercial space to pick up distressed or foreclosed commercial properties of whatever, whether it be warehouse or retail or you name it. But right now, we're going through a period of time where there's some struggle in the retail space, and e-commerce has continued to explode year over year over year, which is making it harder for commercial businesses that are not local based, meaning like a barber or a hair salon or nail salon. I mean, you can't put that online. You have to go visit face to face. But for the other types of commercial businesses, yeah, it's been a struggle. I think that's going to get worse before it gets better. Will it present opportunities? Absolutely. But you need to educate yourself in a different area of real estate. You have to understand how the commercial space works and how leasehold improvements works and triple net leases and all kinds of stuff. It is a little more complicated than residential. This is why residential is just so nice to start in and continue with. So I don't know if I'm answering your question,
Yeah,
but
no, I love that. We could talk real estate all day and I wouldn't be tired of the conversation and all the rabbit holes. You mentioned location. So I'm assuming that you invest in, multiple different states. I always recommend, and you don't have to agree with me. I'm interested to see what you say. I always tell people to start where you know. It's a lot easier to buy in your local market if it's a decent market because you have a little bit of insider advantage. It's the one thing you can't do in the stock market. You can't get insider information, but in your local market, you understand it a little bit better to at least perhaps start with your very first property. But I also know that there's certain areas that are really pushed up from COVID, and there's a lot with a lot of opportunity. Have you done some research on maybe some areas that you think have some great opportunity?
well, let me address your first comment because that's really the big thing I want to push back on with you. Now, I don't disagree with you that you will typically understand your local market, or what I call the backyard, better than other markets because you grew up there, or maybe you live there, you drive around, and maybe you're employed there. So there's truth in that. However, this is where I've had one of my many rules for successful real estate investing is be market agnostic, which means you're not married to any one particular market. If you look at the United States, we have a very large country. It's very much geographically spread out. We have about 500 metropolitan statistical areas. Each of those break down into sub-markets, sub-MSAs, and then those further break down into areas and communities. So you have lots of places to pick and choose from. So if that's the case, think of it as if you were investing in the stock market. If you had your capital to invest and you worked hard to make that money, you want that money to go and work for you and produce the highest returns with the least amount of risk. So if you were investing in stocks, you would probably do some research and due diligence and pick stocks that were a stock that was bound to provide the greatest amount of return. In this case, it's capital gains, but the highest returns. Well, if you live in Southern California like I do, and I want to invest in Coca-Cola, which is based in Atlanta, Georgia, am I not going to invest in Coca-Cola just because I live here in California? It's kind of a strange example, but the point I'm illustrating is you need to be market agnostic, meaning that you should invest your down payment, your investment capital in the markets that have the strongest fundamentals, the greatest potential for upside appreciation, that generate cash flow today, ideally, and in the future, and show promise for future job growth and population growth, because those are the two key fundamentals that you want in a market when you choose a market. So if that's the case, investing in your local market or your backyard might be a mistake. A couple of examples. If you're in the Bay Area of California, like San Francisco, San Jose, way overpriced. Yeah. The price to rent ratio is so out of whack that the property will not cash flow. So you're going to spend $1 million on a property that will rent for about $4,000, $4,500 a month, will not cash flow. So it doesn't make sense to invest there. Mm-hmm. That's more like a speculative play. Another example, let's just say, not to pick on any particular cities, but let's just say you live in the city of Detroit proper. The city of Detroit has been declining for decades. It's not growing in population, nor is it growing in GDP or employment. So that's going to be a problematic market. It'll be very easy to buy there because there's a lot of inventory, cheap inventory, and the numbers will look good when you pencil it out on paper. But in reality, it may not pan out that way. And you'll probably have a lot of problems, and you'll have a lot of tenant issues, and it's just the demographics. Again, I'm not picking on the city, but why would I want to invest in a market like Detroit or even San Francisco when there are so many other markets where I know there's health and growth, strong fundamentals, positive cash flow, and I know that over the years I will have strong appreciation because the potential for that is very strong there because it's growing in population. So this is why I always say that it's not a question of when to invest in real estate, because people will ask me all the time, is now a good time to invest in real estate? I'll say it's not a question of when to invest in real estate. It's a question of where to invest in real estate. There are always opportunities all around the country in all of these areas and pockets. So when you know that, and when you think about real estate investing in those terms, you break down the walls and be market agnostic, all of a sudden you have a lot of opportunity in front of you to pick and choose from.
Yeah. And so to kind of go back to the location topic, you say about Coca-Cola, right? So my brain goes automatically, okay, well, if I invest in a stock in another state, I don't have to manage that company, right? I'm just taking a piece of their profits and it's pretty much hands off. So in order to, if someone's like, okay, yeah, this makes really great sense. I've traveled to Florida. I kind of know that market in and out. I think I'd like to start buying property there. How do you have the new investor or the investor that only has maybe one, two, or under 10 units manage something from across the country into a market that they don't know? Is there some benchmarks or some guidance?
Yeah. So when I first started investing out of state from Orange County, California, this was back in 2003 on the border of 2004. I was investing essentially 2,000 and 3,000 miles away. Some of the properties I was buying is sight unseen. Now, that doesn't mean I was making a mistake, although I did make my fair share of mistakes in the early days. But I would surround myself with the right team. There's a core team of people that you need. But you can do your due diligence, especially today with the internet and virtual services. You don't need to be on the ground. The only benefit in that is you can see it with your own eyes and you can touch it with your hand, but that doesn't change anything. You're still going to hire the same inspectors to do the inspections. You're still going to hire the same property managers to manage the property, and you're not going to be involved, or at least maybe you shouldn't be involved in the day-to-day operations. This is why you hire full service professional property management companies, which is what we've preached for the last 20 years since I started, our turnkey investment company, helping other investors build their real estate portfolios. So there's two types of investors. There's those that self-manage, which is a very large percentage of individual mom and pop real estate investors. And then there's the more passive real estate investors that are, we keep using the word turnkey, but passive real estate investors that will buy and invest in properties in different markets outside of their local area because they're making the best investment choice for themselves at that time. But then they'll bring in, and we do this for them anyway, but anybody can do this. You just bring in a qualified, professional, full service property management firm, not an individual, a firm that can handle everything from tenant screening, tenant placement, rent collection, maintenance calls, and handling maintenance and repairs, and all that stuff, inspections, turnover, all that stuff. So when you have that going on, you're essentially the manager of the manager. You only need to be involved if and when you need to be involved, which is maybe a few times a year, and let them manage the property. And then they just auto deposit the net rent into your account, and you get a monthly statement. And it's not completely passive. It's not completely disconnected, but it's as passive as it can be, dealing with full ownership of residential real estate. So, long
I
answer
love
to
that.
your question.
Yeah, no, that's good. If you were looking like right now, what are some of the in 2023, right? If you're looking to pick up a property, what are some of the cap rates and cash on cash returns that you're looking for now? And where do those exist in the country, the best ones, in your opinion?
Um, so, a shorter answer to that long question, because it's a long answer. Um, if you look at the state of the union, if you will, the state of the real estate market today compared to a year ago, we've seen a dramatic slowdown in most of the markets. So if you look at the top, let's say the top 100 markets, about 42% of those top 100 markets are what we'll categorize as slow, meaning they've slowed down tremendously in terms of price growth, price in terms of appreciation, and price in terms of rents. Still positive, but typically single digit, and usually on the low single digit, mean from 0 to 5%. That's 42% of the country right now, and I'm just talking about the top 100 markets. I mean, this spills over into into more of that, but it gives you a sense. 37% of the markets have normalized. They're in the normal range of single digit annual appreciation, which can be anywhere from like 4 to 7%. Only about 18% of the markets are what we're going to call strong or very strong. In fact, right now there are no markets that we would label as very strong. There's very few of them. So typically strong is about 18% of the markets are still appreciating above 5%, and some of them even like 10% plus, but not very many. And then there's a very small amount that are very slow, and that's typically found in like the Bay Area, San Antonio is one of those markets. Cleveland, surprisingly, because Cleveland has been a perennial cash flow market. So, but it just is really slowed down, and it could be because of industry and
Mhm.
employment. But where you're seeing the least amount of growth is many of the coastal markets, particularly Northern California, and places that have appreciated very, very strongly, like Salt Lake City, Denver, Boise, Idaho, Vegas, Phoenix. Um, Strong appreciation, been running too fast, too hot, and for too long. So now they definitely need to go into a cooling period where that market will normalize. As far as markets go that are strong or still appreciating and healthy, they would include markets like Charlotte, Atlanta, Charleston, North Carolina. So we're talking about the Southeast, and many areas within Florida, which should go as no surprise to many people,
Mhm.
be it Orlando, Tampa, West Palm Beach. The western coast of Florida has been very, very strong for many, many years. Now it's definitely cooled down. It's more of a normal market. But because so many people are moving to the state of Florida, in general, the state of Florida is a great place to look. The Southeast, a great place to look. Texas, not as much as it used to be. The Tennessee, still very, very healthy and a great place for cash flow and cash on cash returns, with the exception of Nashville. Nashville has gone gangbuster.
Insane. Oh,
Yeah, yeah. So, but we like the western half. If you, in fact, if you look at the 25 markets where we have turnkey investment property in available to investors, our clients, people we work with, almost all of it today now is on the eastern half of the U.S. We used to be in Idaho, Salt Lake, Phoenix, Las Vegas, but those markets are just the inventory is low, numbers don't make sense. So now it's flyover country, the Northeast, and much of the Southeast. That's where we're focused because that's where the numbers make sense.
yeah. And when you say as far as the numbers aren't, you're talking acquisition, right? So to buy new properties now, even though the rents might be there, because they definitely are in Phoenix and a lot of the markets that you mentioned, the acquisition price to get them are just so high. Do you feel that? How much do you feel, just guessing, right? We can't see into the future, but how much do you think that some of those markets that are really pushed up are going to cool off?
Well, that's a great question. I almost want to call it the $1 million question.
Yeah, right. It really is.
It really is, because you can make $1 million in equity gains in a relatively short period of time if you knew where that market was going.
Yeah.
But at the same time, you could also be upside down and lose $1 million in equity.
Yeah.
Um, you know, uh, it's hard to time the real estate market.
It is.
Fortunately, real estate does move relatively slow. It's one of the slowest moving asset classes, which is a benefit to investors because you can see what's happening and you can see what's coming and you can adjust without having to, you know, push button invest like you do with the stock market as if you were a day trader. You have weeks and months to adjust with real estate. So, and because of that, real estate can also be very, very forgiving if you buy right, especially in the right neighborhoods. Like the neighborhood is to me one of the most important criteria to mitigate your risk, followed by the market as a whole.
Right. We're all going to have a push up. We're going to have a cooling off period. There may be some recession. People get so freaked out by that word, but all it is really just the reset in the market. How bad do you think this will get? I think how bad it gets is depending on all the opportunity that's available as well.
Yeah. That saying, all real estate is local, there's a lot of truth to that because every single real estate market, first of all, I will say this, I've been preaching this forever. There's no such thing as a housing market. More specifically, there's no such thing as a national housing market. It doesn't exist. You can't point your finger at it and show it to me. Whenever we talk about housing in general at a national level, all we're doing is we're just averaging out certain numbers or metrics across the board, across the top 20 markets or the top 10 markets or the top 100 markets. So you're just taking averages. You're taking the pulse of the housing economy, if you will. But at the end of the day, all real estate is local. So what happens in real estate, especially when it comes to rents and prices, is a function primarily of supply and demand in that local market. And you can get
Mhm.
granular. You could even say down to a submarket, down to a neighborhood. And literally, that's true. It could be down to a
So
street.
true. So true.
So it's all supply and demand driven. So if you want to know what's happening with real estate, and if you want to make some predictions, look at supply and demand dynamics, like anything related indirectly or directly to supply and demand in a particular market, because that will give you kind of like a leading indicator of sorts in what's going on in that area, that neighborhood, or that local market. So this goes back to what I was saying before. Like markets are adjusting. Some markets are adjusting more so than others, like the overpriced, overheated markets, being on the western half of the U.S., like the Bay Area. Whereas other markets are just taking a breather because demand still far outweighs supply, like in the southeast and the northeast, where prices will adjust or slow down, maybe correct a bit, but over the next few years, as time goes on, they will continue to appreciate rents and prices because there are more people needing those households, those homes, uh, that than there is supply. And so it's just basic economics 101.
Yeah. What do you think are some of the maybe mistakes that you see? I mean, you work with a ton of investors that go through as students and your training. And I mean, you have an ultimate guide to passive real estate investing that people can kind of get started with. What are some of the mistakes that you see people make maybe before they come to you as they're trying to do this on their own?
Wow. Okay. So I guess the first would be we already talked about it, and that is not realizing that you can invest anywhere in the U.S. That you should be market agnostic to understand that there are lots of places to invest, which means there's a lot of opportunity for you. So choice.
Yeah.
Um, so once you take the blinders off and you open up your scope to the entire country rather than just your backyard or your local market, you'll do a lot better. You'll be far more successful, and your wealth creation will happen faster. So that's one mistake. Two is sometimes people invest from the bottom up instead of top down. And what I mean by that is a lot of times people will be looking at properties in a particular area or their backyard or where other investors are investing because that's where they're investing. And so they start looking at properties, but they spend very little time, if any, looking at the market, meaning the fundamentals of that market and the health of that market and the neighborhood that it's in. It's easy to buy a property, but once you have it, you can't move it. If all of a sudden you close escrow on a property, and let's say it's newly renovated, there's nothing wrong with it, no deferred maintenance, and the numbers look pretty good on paper, like you've underwritten the numbers and you invest in that property. Well, what if the neighborhood is not desirable? Like there's low demand for it, or there's high crime rate, or there's terrible schools in addition to increasing crime, or whatever it may be. You can't change that. You can't pick the property up and move it to a better neighborhood or a better location. It's there. It's rooted. So a lot of investors I've seen, and I've done this too, made the mistake of focusing so much on the property, the numbers, the condition, and all that stuff, that they invest in the property, but they're not really investing in the neighborhood, the area, and the market. The
Mm.
top-down approach, which is my sixth rule of my 10 rules of successful real estate investing, is to start with choosing the market or the markets that make the most sense, and then working your way down to the areas or submarkets, then the neighborhoods, and then start looking at properties in those neighborhoods that meet your criteria as a real estate investor, the demographics, the availability of the numbers like cap rates and all that kind of stuff. So top down approach rather than a bottom up approach. So that would be another mistake to avoid. Another one is if you don't know what you're doing, if you're a new real estate investor or you're just getting started, don't try to self manage, even if it's in your local market. Learn the business of investing in real estate from having professional full service property management companies doing the work and understanding all the pieces of it as you go. Then if you want to self-manage, choose to self-manage. And there are a lot of tools online to help you do that, especially today. There wasn't as many tools 10 years ago, 15 years ago, even 5 years ago as there is today. Today, you can basically handle everything from finding, screening, and qualifying tenants, placing the tenants, and showing the properties without you ever being, on the ground. So there's
Yeah.
a lot of self-management tools out there today, but a good place to start is actually with management companies that, can expose you to the ropes, if you will. So those are
Yeah,
three.
those are great because I think the thing about the management company is really important is because are you an investor or are you a landlord, right? Do you want to actually manage the day to day? And if you're doing that, then you can't really be sourcing and finding new properties that are going to create new assets to build more wealth. So I think that that's important to people to have that distinction of do you really want to be the property manager or do you want to be an investor? Because the more time that you're spending on that one property that you already required, you're taking time away from finding new deals and expanding your portfolio. So I love that. Was there something else you wanted to share? Was it another one of those rules? I'm so interested to know what your 10 rules are. Is that in your ultimate guide to passive real estate investing?
I believe it's in there. Yeah, I believe in there. And even if it's not on our website, it's a sticky post, which means it's always at the top of our blog. It never moves from number one. So it's the first thing you see, and you'll always see it there, just because it's kind of like that foundational blog post. It's like, here are the 10 rules that that I cut my teeth on and made mistakes on, and now here they are for you.
I love
So
it. I love it. Can you give us one more, maybe off the top of your head?
yeah, well, it's not a mistake, but yeah, definitely
Yeah,
give you
that's
one
okay.
more.
Sure.
Yeah. So I always start my presentations with this as well. The first thing I always tell people or even ask people is well, my first rules is educate yourself. Number one, educate yourself. Okay. So when I'm doing a presentation, and I've done presentations to as many as 2,000 people in a room, my first question to them is, finish the following sentence. Ignorance is blank. And what do you think most people say?
Most people probably say bliss, right? Because that's what the saying has always been.
Correct. That's
And I wouldn't say
exactly what.
that. I would say it's costly. I
Well,
would say ignorance is
you're on the
costly.
right track. You're on the right track. So I always ask them. That's the answer I get. It's bliss. But then I always tell them. I say, to me, ignorance is expensive.
Yes.
So you don't know what you don't know, and what you don't know is going to cost you opportunities, time, money, you name it. And it doesn't have to be in the financial world. It could be in your personal life. It could be in your relationships. It could be in virtually anything. But ignorance truly is expensive. It speaks to the saying that, what you don't know won't hurt you. Well, that's absolutely wrong. What you don't know can and usually will hurt you, because if you don't know the right things to be doing, saying, looking into, investing in, et cetera, it's going to cost you. And you don't even know it's costing you. You don't realize it. And that's a problem, because ignorance comes with a tremendous price. And that price is that those who are ignorant, and I don't mean this in a derogatory or negative sense, but those who are ignorant never really realize the fact that it's coming with a tremendous price. I mean, the biggest takeaway from this interview is this. If people listening to this interview remember nothing else, remember this one thing: the cost of ignorance is more expensive than the price of education.
Ooh, it's so good. Say that again.
The cost of ignorance is more expensive, far more expensive than the
Yep.
price of education.
So good.
Education can be literally free. I mean, there's so many good resources online, podcasts,
Yep.
like yours and mine. Books are $10-$20. I mean, what kind of
Yep.
excuse do you have to not
Yeah.
educate yourself?
Yeah, I love that. I think it's important to remember too that investing, just like building a business, is a skill. And if you want better returns than the average investor, you need to put more work into learning, understanding, educating yourself. And what's
Yeah.
great is you don't need to go to college and go into debt to learn this stuff. You can actually, like you said, it's free as long as you're getting the right information. Because I think also misinformation can be very expensive. For some reason in the digital space and on social media, there's so many people talking about real estate and having funds, and they're like on their first property or their second or third property. And so I think it's important to obviously work with someone that has experience like you do. I love what you're doing, and I know everyone's going to want to get the rest of those 10 rules. I know you have a guide. Where can we find that?
Yeah, there's a lot of domain names that I bought. I have an account on GoDaddy, and I have like well over 100 domain names, and they all kind of point to all my websites. Excuse me, but the mothership website, if you will, is Norada Real Estate. Norada is spelled Norada. Norada, however you want to pronounce it, but NoradaRealestate.com is our main real estate website. And there's tons and tons and tons of resources on there. We probably post 3 blog posts a week at least on there right now.
Awesome. Oh, that's
Yeah.
great. Just education about what's going on in the market and real estate investing. That's so great. Awesome. So we'll make sure to link that up in the show notes. Otherwise, too, where else are you online? I know you have a podcast. Let's promote that. Where can they find your podcast? What's the name of it?
Well, thanks for asking, Candy. I appreciate it. So my podcast is aptly titled Passive Real Estate Investing. The website is passiverealestateinvesting.com. The show is called Passive Real Estate Investing. You could find it on iTunes or wherever. Just type in Passive Real Estate Investing. So it's pretty easy to find.
Yeah, I love it. And I recommend everyone go listen to it. And I don't do that very often because, like I said, most times the information I'm not 100% aligned with, but we have a lot of commonality in everything that you talk about. So I love that. So everyone go check that out too, to get your weekly real estate dose. And this is one question I always ask everybody at the end of the interview. And I'd love to know your answer to this. Is obviously the show is Generation Wealth. And we talk a lot about wealth. Real estate investing is obviously wealth. But now doing what you've done for so long and being in business and real estate, what does the definition of wealth mean to you at this stage?
Time. It comes down to time. Look, there's a difference between being rich and being wealthy. You can have, millions of dollars. You could be a billionaire and be rich, but it doesn't mean that you are necessarily wealthy. I mean, it makes it far easier. But unless you convert that wealth, let me take that back. Unless you convert those dollars or that pile of cash that you have that makes you rich into a predictable passive income stream that affords you to do what you want when you want on your own, live life on your own terms, you don't actually have time freedom. So ultimately, what we want is not the money. It's a means to an end. It's a vehicle. Ultimately, what we all want is to be free. We want time freedom. Well, how do you have time freedom? You need financial freedom. At least financial independence, but certainly financial freedom. Financial independence allows you to do what you want when you want. It allows you to survive and live. So we want that financial independence or that financial freedom to give us that time freedom that comes along with it. So for me, wealth measured in financial terms is all about time, free time.
I love that. Thanks for sharing that. I know so many people that make a lot of money but don't have a lot of time. And so I think it's a really important distinction. So thanks so much for coming on and spending this time with us. I know you've got so many things going on. And so I just really appreciate you pouring into the audience and everything that you're doing. And guys, we'll link everything up to the show notes so that you can find more about what Marco is doing and all of his great stuff. Thanks again.
Thank you, Candy. Appreciate it.
And don't forget that if you didn't buy a copy yet of Wealth Habits, it is now available on Audible. And thank you so much for all of your support because we are #1 bestseller, new release in multiple categories. And of course, if you already have a copy of the book and downloaded it and listened to the book, please consider leaving a 5-star review over on Amazon. It would mean the world to me, as well as many other readers that need this information. Okay, guys, that's it for today. We'll see you next time on Generation Wealth.